Imagine you're sitting on a strategy so powerful it consistently outperforms traditional portfolio models. It's robust, it's intelligent, it learns from the past, and yet no one wants to use it. Why? Because they don't understand how it works. In today's video, we're stepping into the world of supervised portfolios and interpretable machine learning in finance. We'll explore why many promising models remain on the shelf and how one innovative algorithm might finally bridge the gap between machine intelligence and human trust. If you're a finance professional, data scientist, or decision maker trying to unlock AI's full potential, this is the video that changes your perspective. Stick with me until the end. You'll come away with the clarity others are still searching for. Chapter 1. What are supervised portfolios, and why don't we use them more? Supervised portfolios represent a compelling evolution in asset allocation. The approach typically unfolds in two stages. First, the optimal portfolio weights are calculated for specific points in time, using methods such as mean variance optimization. Next, a supervised machine learning algorithm, often something like gradient boosting, is used to predict those optimal weights moving forward. It's a smart, data-driven solution designed to generate more stable portfolios with superior risk-adjusted returns compared to conventional models. But there's a catch, and it's not technical, it's psychological. Many of these machine learning models operate as black boxes. Their internal logic is difficult to interpret, making it challenging for executives and stakeholders to understand, let alone trust, the outputs. In high-stakes environments like finance, where millions or even billions are on the line, this opacity breeds skepticism. Regulation only heightens this concern. European laws such as the GDPR now mandate that any automated decision-making process must come with meaningful information about the logic involved. Without transparency, adoption stalls, no matter how good the model. Chapter 2. Why interpretability is the missing piece. Interpretability isn't just a feature, it's a foundational requirement in finance. Without it, models that appear statistically sound remain practically unusable. Human beings, especially those responsible for managing capital, struggle to trust decisions they can't explain. This is known as algorithm aversion, the tendency to reject a model, even a highly accurate one, if its reasoning can't be clearly understood. Moreover, regulatory authorities are tightening the rules. Transparency is no longer optional. Financial institutions must be able to explain not only what a model recommends, but also why it arrived at that conclusion. Interpretability supports trust, facilitates compliance, and offers practical benefits too. When a model underperforms, an interpretable structure allows professionals to diagnose and correct the issue. In contrast, black box systems often leave users flying blind. Chapter 3. 2 paths to interpretability, but only one is built for trust. To make machine learning models understandable, we generally follow one of two approaches. The first is called Post-Hoc interpretability. This involves explaining a model after it's been trained. You treat the model like a sealed container and then use tools like Lime or Shapley values to guess how it works. While flexible and widely used, this method is inherently approximate. It can be misleading and is vulnerable to manipulation. The second approach is intrinsic interpretability. Here, the model is constructed in such a way that its decision-making process is transparent by design. Think of linear regression, decision trees, or rule-based systems. Every output can be traced back to its input in a logical, human-readable way. When it comes to sensitive decisions, such as allocating capital or managing client portfolios, intrinsically interpretable models are the gold standard. As Professor Cynthia Rudin and others have argued, these models don't just tell you what, they show you why. Chapter 4. RuleFit, the best of both worlds. Enter RuleFit. This algorithm has emerged as a frontrunner in the pursuit of transparency without compromise. It works by first extracting decision rules from a series of ensemble trees, models like random forests or gradient boosting machines. Each tree is essentially a flowchart of decisions, and each path through that chart becomes a rule. For example, if the outlook is sunny and the humidity is high, then that's a rule. Once these rules are generated, RuleFit combines them, along with the original features, into a sparse linear model. It then applies regularization, typically using Lasso, to eliminate less relevant variables. The result is a streamlined formula that incorporates only the most significant signals. What's more, every component in the final model is fully interpretable. You can see precisely which rule led to what recommendation and how much weight it carries. Chapter 5. RuleFit versus Gradient Boosting. Does interpretability cost performance? The natural question is, how well does RuleFit actually perform? In a detailed empirical comparison, RuleFit was tested against gradient boosting across 3 investment universes: 10 U.S. industry portfolios, 25 size and book-to-market sorted portfolios, and a mix of 4 asset class indices. The results were surprising, but in a good way. RuleFit's performance was statistically on par with gradient boosting. Sharp ratios, returns, volatility, and drawdowns all showed minimal differences. In some cases, gradient boosting offered slightly lower turnover, but the margins were small, and in many datasets, RuleFit held its ground. Even more compelling was the model confidence set analysis, a rigorous statistical method that identifies models whose performance is indistinguishable from the best. RuleFit consistently ranked near the top. This challenges a long-held assumption in finance, that interpretability must come at the cost of accuracy. It doesn't. Chapter 6. What the model teaches us about the market. One of the most valuable aspects of an interpretable model like RuleFit is what it reveals about the structure of financial data itself. In this framework, it becomes clear that interactions between characteristics matter deeply. It's not just about identifying individual features like volatility or valuation, it's about how those features combine. For example, a portfolio might favor stocks that exhibit both low idiosyncratic volatility and high R&D intensity. RuleFit also dispels the myth that only a handful of features drive returns. While a tiny subset may seem appealing for simplicity, the reality is more nuanced. In the study, 30 out of 89 characteristics accounted for 75% of model importance. That's a middle ground between excessive complexity and oversimplified parsimony. Feature importance also evolves over time. Some metrics rise and fall with market conditions, while others remain relatively stable but spike when they become especially relevant. This dynamic insight is a goldmine for portfolio managers who need to adapt, not just once, but continuously. Chapter 7. Why Adaptive Lasso Makes RuleFit Even Smarter. While standard Lasso is a powerful regularization tool, it has one major flaw. It doesn't satisfy what's known as the oracle property. This means it may not always identify the correct set of variables, especially when those variables are correlated. To address this, RuleFit can be enhanced with Adaptive Lasso. This technique applies variable-specific penalties based on initial estimates. By doing so, it sharpens the model's ability to distinguish between signal and noise. Irrelevant variables are zeroed out more confidently, and the remaining coefficients are estimated with greater precision. The result is a model that is both cleaner and more accurate. Chapter 8. Avoiding the pitfalls of data snooping. No matter how sophisticated your model, if your evaluation is flawed, your results are meaningless. That's where the concept of data snooping comes in. When a model is repeatedly tested on the same dataset, it risks learning patterns that don't generalize, patterns that exist only by chance. To guard against this, the study implemented a suite of robust safeguards. It used a multi-year out-of-sample testing period, holding out a 5-year buffer zone for hyperparameter tuning. It employed purged cross-validation to eliminate temporal leakage, and it re-estimated models on expanding data windows, mimicking how models would update in real-world deployment. Finally, it applied the model confidence set framework to ensure that any performance comparisons were statistically valid. These safeguards collectively ensured that the observed performance was genuine, not a mirage. Now that you've seen what's possible, transparent AI, powerful portfolio models, and trust built into every decision, the choice is yours. Supervised portfolios and interpretable machine learning aren't theoretical anymore. They're real. They work, and they're ready for adoption. If you found this video enlightening, help us spread the word. Like this video, share it with your peers, and subscribe for more expert-level content on AI, finance, and the future of investment. This is not just the next chapter, it's the next standard.